We are in what is really a war. It's not just a war that's going on in the globe, but it's also a war that's incorporating gold. And I mean, spoiler alert, have my targets changed? No, absolutely not. Bottom line, all the bullion banks who estimated $6,000 gold plus or minus $6,000 gold are still projecting prices between 6 and 7,000. Basically, gold did what it was designed to do. When the sovereigns and central banks bought it for a black swan event, that is exactly what provided the liquidity. And sure, we saw, and that's what partly drove the sell-off, but it was the PPT that overshot and leaned into that and overshot it. It's done.
The global financial landscape has shifted into a gold war, where the precious metal is being weaponized by sovereign nations and central banks alike. Despite recent market volatility, the fundamental targets for gold remain locked in, as the asset performs exactly as designed during high-stress liquidity events. Andrew Maguire, a world-renowned precious metals whistleblower and market analyst, explains that while a recent sell-off occurred, it was largely driven by the Plunge Protection Team, PPT, overshooting their intervention. He notes that major bullion banks are still maintaining aggressive price projections between $6,000 and $7,000 per ounce. This bullish outlook is supported by current Basel III regulations and the massive physical drain of Western vaults by Eastern sovereigns. As central banks continue to utilize gold as the ultimate black swan insurance, the paper market's attempts to suppress prices are becoming increasingly ineffective against the sheer volume of physical demand. Now, we present the clips from Andrew Maguire's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
We are in what is really a war. It's not just a war that's going on in the globe, but it's also a war that's incorporating gold. And I mean, spoiler alert, have my targets changed? No, absolutely not. But let's have a look. In order of scale, this is really important. To understand it is really important. Let's review the actors selling gold this week. And their various motives, of course. Let's take a look at the chart footprints, and that's going to, and then we'll align them with the various actors in play. This paper to physical inflection point was triggered on Monday when gold hit very large central bank bids on the approach to the rising gold 4,090 200-day moving average. It illustrated really provided the first visible sign of returning central bank and sovereign safe haven gold buying into rising oil prices, into the synthetically driven gold price correction. Now, while real rates or higher so-called real rates automates mechanical institutional selling and disincentivizes gold investments, the PPT has been utilizing this natural tailwind to target all remaining speculative longs, and in turn to tip the January momentum naked long buy mantra, which was here, instigated here, into a naked short momentum driven downside. So bubble territory long here, bubble territory short here. And the big tell here was that the scope of the selling far exceeded plain vanilla ETF liquidations. Now, into the 27th day of this conflict, it's clear that alongside speculators, some sovereigns have been forced to cash in gold hedges to meet unfactored cash flow dollar shortages. However, this reversed on Monday into this close test of the 200-day moving average, where very large central bank and sovereign-related buying was triggered. Now, what's interesting is that because this far too obvious target was by no coincidence front-run by the PPT, only a fraction of these central bank physical orders were tagged, and we're certain that global central banks and sovereigns are trailing this all-watch 200-day moving average higher, limiting the PPT's downside scope for more selling. So as I record this episode on Wednesday, following what is basically a 27% synthetic correction from the all-time highs into the returning central bank and sovereign buying on Monday, which occurred here, this morning gold's up over 8%. Off Monday's lows, and I view any further synthetically driven dips will be jumped on by central banks and a lot of physical stackers that I personally know as well. Now, while the mainstream media continues talking synthetic gold lower, the Fed's been caught in an impossible trap. Triggered by the unfactored and lingering inflationary oil shock, they can't cut rates, but they can't raise rates without accelerating a $36.2 trillion national debt service spiral. Now, the only available choices for a trapped Fed are to monetize or trigger a debt crisis. Now, under this chart noise, liquidity providers now report central banks and sovereigns are already rebuilding gold assets to front run this precise scenario. It's coming down the pike.
We are witnessing a global gold war where the metal is performing its primary function as the ultimate insurance policy for sovereign nations. A massive synthetic correction of 27% from all-time highs was recently met with heavy central bank bids as gold approached its 4,200-day moving average. This inflection point highlights a massive divergence between paper market manipulation and physical reality. While the Plunge Protection Team, PPT, has utilized rising real rates to trigger mechanical institutional selling and flush out speculative longs, sovereigns are treating these dips as essential liquidity events. The Federal Reserve is currently trapped in an impossible dilemma. They cannot cut rates due to an inflationary oil shock, yet raising them would trigger a death spiral for the $36.2 trillion national debt. Underneath the market noise, liquidity providers confirm that central banks are aggressively rebuilding gold assets to front-run a looming debt crisis. Any further synthetically driven sell-offs will likely be absorbed by these large-scale physical buyers. Let's get back to the interview.
This is exactly the cycle inflection point. Our liquidity providers are now being asked to buy gold to accommodate. And under the chart noise, central banks and sovereigns are already front-running this scenario. Hence, gold buying has stepped up. This is the inflection trigger point for the gold trade to reverse, which has always followed every single such derivative physical gold price suppression event. Gold rallies back, recharged. There's no speculators on board to rinse, and it makes new highs. So let's put this into perspective with the largest ever historical PPT gold price correction. Let's look at it. So here are the footprints that led up to a 4-year, 45% PPT-driven correction, which occurred from here to here. Now, bearing in mind, while the scale of this seems muted compared to what we've just witnessed, obviously, from a scale perspective, this is a far less. This was only 27%, and with an 8% rally, this was a 4-year, 45% PPT-driven correction, which directly followed the 2008 banking collapse, where, following a very similar to what we're seeing right now, black swan dollar funding shortage, evidence gold. So really, we saw that initial selling that to meet that. And again, this was hedges being called in. So essentially, to meet that, what that did was essentially, as soon as that was done, gold demand accelerated into what was really the fear of another collapse of the broken banking system. And this drove gold. I mean, really, they were racing to exchange debt-based dollars for gold. It drove gold from 680 in 2008 into the 1923-2011 highs here. And this 3-year gold accumulation period encompassed a period where the IMF had refused to allow the PBOC to buy 200 tons of its last ever gold sale. This was the 403 metric tons, the last ever sale by the IMF, where 200 tons was sold to India, and the remaining 203 odd tons was drawn back into inventory for the sole purpose of manipulating the markets or capping gold. The reason we know that is because China offered to buy the remaining 203.3 metric tons at market and were refused that sale. And it was this point in 2010 that China opened up its gold market to its citizens, and basically this. Do you remember that the house size gold billboards and television adverts to buy gold? But the physically driven rally saw gold leaving the West on a one-way journey to China. And what it did was disrupt the PPT derivative game, exposing the divergence between COMEX and LBMA derivative gold. And the shrinking supply began to expose the degree of gold rehypothecation. And this was a major problem for the bullion banks. So the reason I bring this up is relevant to now. Fresh off the 2008 banking collapse, with faith lost in the system, by the end of March 2013, which I've marked here because that was a really relevant point to actually look at now. So basically, this was the moment that the physical delivery requests seriously overwhelmed the COMEX and the LBMA. I mean, noticeably, and their ability to deliver into these delivery requests. And it prompted the now infamous PPT meeting where all the too big to fail bullion banks were called in to a presidential meeting on the Sunday night before the 1st of April officially orchestrated price smash that lasted all the way to 2016. Here, the price smash has lasted literally 6 weeks. Whereas in the global picture, it's only the West's focus on derivative gold that is actually being challenged. Under the covers, the entire global South are busy converting overpriced dollars into underpriced physical gold. Bottom line, all the bullion banks who estimated $6,000 gold plus or minus $6,000 gold are still projecting prices between 6 and 7,000. So basically, gold did what it was designed to do. When the sovereigns and central banks bought it for a black swan event, that is exactly what provided the liquidity. And sure, we saw, and that's what partly drove the sell-off, but it was the PPT that overshot and leaned into that and overshot it. It's done.
We have reached a critical cycle inflection point where the divergence between synthetic price suppression and physical reality is finally collapsing. History is repeating itself, echoing the aftermath of the 2008 banking crisis, when a black swan dollar shortage forced a temporary gold sell-off, only to be followed by a massive recharged rally to new highs. The recent 27% paper correction, orchestrated by the Plunge Protection Team, PPT, has effectively rinsed out speculators, leaving the market thin and ready for a powerful reversal. Central banks and global South sovereigns are no longer falling for these derivative Jedi mind tricks. Instead, they are aggressively converting overpriced dollars into underpriced physical bars, front-running the next inevitable systemic reset. The institutional gold war is reaching a fever pitch as the rehypothecation of Western gold is exposed by shrinking supplies and overwhelming delivery requests. While Western markets focus on manipulated paper quotes, the smart money is tracking the massive physical drain toward the east. Bullion banks and liquidity providers haven't blinked. Their long-term targets remain firmly between $6,000 and $7,000 per ounce. Gold has performed its duty as the ultimate black swan insurance, providing essential liquidity before its inevitable ascent. As the Fed remains trapped between a debt spiral and monetary collapse, the floor for gold is rising. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Don't forget to hit the notification bell so you never miss an update. Thanks for watching.